Another crazy week in the market, and we have Mr. Jim Welsh, who's coming in from a remote location with us today. He's joining us. It's Friday, so Jim couldn't miss this interview, of course. Jim Welsh, how are you?
I'm doing good, Blake. How you doing?
Great, great. You know, you're in a different location. Where are you at this week?
Well, instead of a beach being behind me from San Diego, we're in Tucson, and you can kind of tell from the picture behind me, those are cactuses. I'm not that far from you. I'm in Arizona. We're in the same state.
You're in the same state, still a couple hours away, but it's nice to have you in the great state of Arizona. So from your point of view, and I know you were in your office the majority of this week. Have you seen a lot of things evolve over the week? What's your takeaways right now, and what are you seeing?
I think the biggest overriding issue, and we've talked about this the last 2 weeks, is a lot of people didn't think President Trump was going to follow through on the tariffs. And of course, he has. And so for a lot of folks who were of the mind that, he was bluffing in a sense, he was just using the threat of tariffs as a negotiating tool, that surprised them. And that uncertainty, I think, has shifted, if you will, the balance that has been in the market for maybe 2 years, in the sense that for most of the last 2 years, there wasn't a reason to sell. And occasionally something would show up and we'd have a flurry like last August when the yen kind of blew out. We had a quick, sharp pullback, and then it was over. And so buy the dip mentality, came back very strongly. With the level of uncertainty we have now, and this has been kind of my take, is that we really don't have a reason to buy near term because there's so many important details that we just don't know how they're going to play out. And I think we've seen that in the way the market's traded, where almost every day it seems like there's a rally that then gets sold into fairly quickly. So I think that's the biggest change, is that everyone is kind of, just sitting on their hands a little bit. And, it's an important concept. When there's no reason to sell, it doesn't take a lot of volume to push the market up. The flip side, obviously, if people are boycotting buying, it doesn't take a lot of selling to drive it down. And what we have seen, obviously, volume has picked up fairly significantly, Blake. We've seen the market react, in less than a month, down 10%. That's a pretty big move.
Yeah, it sure is. Now, I mean, but are we in an environment, Jim, where you can actually see a pretty good short squeeze at this point?
I think it would take some real positive news on the tariff stuff, Blake. In other words, you'd have a clear runway for a period of time where you didn't have to worry about an announcement tomorrow or the day after, or, not just from President Trump, but from the trading partners. I think that's going to be difficult between now and April 2nd, because that's when tariffs are scheduled to go in on every country that we have a trade deficit with. So to me, that's an overhang out there. And I don't believe, it's very unlikely that event isn't going to happen. So can you get a short squeeze? Yes. Can it be compressed over 2 to 4 trading days? Yep. And I think that's kind of more likely where the environment we're in, is that I just don't see we have the framework for a sustainable rally in the market. There's just too many known unknowns.
All right. Well, Jim, let's jump into your charts. And I know your first chart here is a clover. What does that represent? Just kidding.
Well, it's a 4-leaf clover, so it represents luck. And as I'm sure everyone knows, Monday is St. Patrick's Day. And as an Irishman, I would be very remiss if I didn't include this in our discussion today. And so, on Monday, everyone is Irish. And hopefully everyone has the luck of the Irish on Monday.
All
So
right,
happy
Jim.
St.
Well,
Patrick's Day.
happy St. Patrick's Day back at you. Now, your first real chart, not real
What
chart.
do you mean? What do you mean? That's not a real chart. Come on,
I
Blake.
know it isn't, but you tell us a little bit about this recession fears
Yeah.
chart that you have here.
Well, this is part of, if you will, one of the reasons why people are no rush to do buying. 3, 4 weeks ago, you can see the word recession was pretty monotone going back the last 2, 3 months. People were, that wasn't top of mind. That's changed very significantly in the last 2 to 3 weeks. And on the right-hand side, you can see the probability of a recession, which I think was down around 15%. Especially over the last week, we could see this sharp increase to 40%. So that, in part, I think, Blake, one of the things that the market has been feeding off of for much of the last year is the belief we don't have to worry about a recession. The economy's chugging along okay. And, sooner or later, the Fed will probably cut. But the main thing is the economy's okay, earnings are going to be all right. And so that has been called into question. And again, it's one of the reasons why the market, I think, is unlikely to be able to have a sustainable rally until we know more about the tariffs and how all that's going to play out.
Got it. And what's the next chart as far as the credit spreads widening? I mean, how is this a risk and how does it play into
Yeah.
your full thought process here?
Well, this ties in. The left side is investment grade, so it's good quality corporate bonds. The right side is high yield. And when people are optimistic about the economy, they're not worried about defaults. And so the spread between investment grade and high yield corporate bonds is narrow relative to treasury paper of varying maturities. And what we've seen is for the first time a pretty good spike. The spike going back to again August of last year when the yen carry trade kind of got unwound for a handful of days. That was that last spike over there. So this hasn't gotten to where it's like, oh my goodness, type of levels. But the shift and the change is reflective of the shift in people's mindset. It's like, wow, I wasn't worried about a recession a few weeks ago, and now I have to at least consider that the risk of a recession is going up. Therefore, I'm going to want higher yields on corporate bonds relative to treasuries to compensate for that risk. So this, all these charts are, I think, showing a composite of how people's thinking has shifted in the last 3, 4 weeks.
And what's interesting though is your next chart, Jim, because you talk about this is the worst start that we've seen in the dollar. And usually when you have risk aversion, the market's a little risk off, the dollar tends to catch a bid, but it really has not been the case this year.
No, the tariff threat, the implications for the economy in terms of the U.S. economy slowing, coupled with, as we talked last week, we've seen the EU really have kind of a metamorphosis in terms of, okay, we're going to ramp up defense spending by over $800 billion. We're going to allow EU members to have deficits above 3%. Uh, as long as it's being driven by defense spending. I mean, this is an enormous shift. So that perception is helping people think that, hey, the European economy is going to get a jolt, a positive jolt from all this spending. And in the meantime, we've got the tariff stuff and the outlook that the U.S. economy is going to deteriorate. So you're right. Historically, in times of big uncertainty, normally the dollar catches a bid. But the reasons for the uncertainty are and have been a negative for the dollar. And as well, we'll get into the dollar chart in a while. But this is just kind of noteworthy that we're seeing this. And the interesting thing from my perspective is that the chart analysis that you and I've discussed for really 2, 3 months probably, was implying that the dollar was vulnerable to a fairly decent sized decline this year. And, the reason, kind of appeared more from the tariffs, which is ironic because a lot of people have thought, oh, tariffs are bullish the dollar. And on February 3rd, when the tariffs were first announced, the dollar got a pop. It quickly gave all that away. So again, in a lot of markets, we're seeing a big shift because of what President Trump is doing and the uncertainty it's created. And also, there's some negative aspects to it too.
Right now, Jim, there are, and it is one of those things that when we see the dollar sell off the way it is, there is so much feeding into it. But one thing that you've done is you've actually been calling for a pretty severe dollar decline in recent in
Yeah.
recent weeks, and we've seen that. So I just want to pause here and say, if you guys appreciate what Jim does every week, he even is traveling on holiday with his wife in a different state. He's still here with you guys. So make sure you give him a thumbs up and subscribe to the channel so you don't miss any of this like content that Jim provides. And make sure you check out Macro Tides too. Hey Jim, so the next chart I want to bring
Yep.
is I'm gonna bring you over to your actual technical charts where you have the S&P and
Right.
tell us what you're seeing here.
Well, when we talked last week, I had that channel on there, and I noted that we were below the top line, and that the odds were pretty good that we would make a trip down to the lower channel line, and that lower channel line was just below 5,600 or like 5,570. And obviously, I think the S&P got down to what, 5,504 or 5 so on the cash.
Yeah.
Now we're getting back into that channel. The upper channel line is around 5,750-ish. Maybe, you stretch it to 5,800. So my guess would be that that's a likely target zone for this rebound. The market's oversold. Now today is quadruple witch, expiration of options and futures and options on futures and stocks, the whole bit, which probably is giving some octane to the move today. But to me, we're likely to see a choppy move up toward that upper channel line over the next, let's say the next week.
All right, and Jim, it's different charts than you normally use, probably because you're traveling.
Yeah, I
Um,
don't have access to my normal charting program. So,
right. So what is the red and the green? What moving
oh,
averages
okay.
do they
The
those
red and the
represent?
green are the usual 5 and 13 exponential moving averages on the S&P 500. And, you can see once the 5 closed below the 13 way back on probably, I think it was either February 20th or 21st. And you can see this wide gap now between those two lines. So I'm glad you brought this up because what's likely to happen is people have had a number of reasons to be sellers. Those reasons just didn't disappear overnight. And so what will happen is people who look back and say, gosh, I wish I sold 2, 3 weeks ago, they're going to be inclined to sell into the first rally. And what that implies is we're going to see a fair amount of choppiness still and going sideways, so like an upward zigzag. And that gives the time and creates the time for the 5 and 13 to start to pinch and get closer together. So the main point though is, people have been given good reasons to sell. Those reasons didn't disappear. I mean, look at about the CPI. If we got that CPI report a month ago, I think the market would have said, yep, and we would have seen a rally that lasted more than a few hours,
Yeah.
you know. So it kind of just shows that front and center is the tariff stuff and the implications for the economy. And none of that's changed. It's not like President Trump said, you know what? Uh, we're not going to do this anymore. That's
Right.
not going to happen, you know.
All right. Well, the next chart you brought, and usually, and we're I'd say we're going out of order, but it's not necessarily out of order. It's your order, Jim. The next chart you brought is gold, and you've been looking
Yeah,
for a pullback, but we've failed to do that. We keep
yeah,
hitting
yeah,
new highs.
yeah.
Even this week, we went
Well,
above 3,000. So is this it? I mean,
yeah.
are we going to finally pull back now?
Yeah, I mean, again, the take has been that we were going to see a rally that would take gold up to 3,000. The path has been, with very little pullbacks. We had a sharp break, 28.35. I thought we'd have a bounce, dip below 28.35, and then go up above 3,000. Instead, you can see from 28.35, you got one, two. I think this move above 3,000 is wave three of five. And this is 5 from 25.41 low. And I think it's wave 5 from the low in September of 2022. So given the
So up
enthusiasm,
here we are at five somewhere.
5 of 5 of 5 type of stuff. All
Okay. So
right.
now it goes
Yeah.
straight down to 400. I'm just kidding.
No.
Joking, guys. But
Yeah.
being that it's 1, 2, 3, 4, this would
Four,
be 5,
five.
right?
Right. Now look at the bottom panel on the RSI.
It's
So
divergent.
back when we were topping at, wave three,
Yeah.
the RSI was above 80. It's not even to 70. I mean, these are the classic setups. And to me, where RSI is most valuable is when you get divergences, but the divergence is occurring when the RSI is below 70. So, I mean, if you get a divergence between 85 and 80,
Yeah.
80 is still a really strong number. Yes, it's a divergence, but when you get it where the divergence is as large as this, more than 10 points, and the RSI is below 70, it's just the probability that you're nearing a high is much, much better. And we're also, obviously, you can see the trend line connecting the high of wave three, going back to that 2789. We're bumping into it. So can briefly get above it? Yeah, sure. But again, so for me, Blake, we've seen this big decline in the dollar. Sooner or later, it's going to get a bounce too. And gold to me looks like it's nearing the end of its run.
All right. Well, the last chart you brought, oh no, you got two more charts. You have the
Yeah.
dollar. Speaking of the dollar, let's get over to it.
Speaking of the
So
dollar,
here's your
yeah.
dollar.
So, again, last week it was like, okay, there's support, 103.40-ish, based on that low you can see just above the letter B. So RSI is below 30. I think potentially the dollar gets a little bit of a bounce, maybe back up towards 105, maybe. And then there's another drop, I think, coming. In other words, we've had one, two, we probably just finished off wave three with the lows this week. We're in a little wave four bounce. I think there'll be another dip that takes out these lows, and that will be 5 down and set the dollar up for a better bounce that maybe does get back up to 105, 105.50 before the next larger wave of decline takes hold. So, you know, as I've been saying for quite a while, I think the dollar is going to make a run at 95 sometime this year.
And it
And
doesn't happen in one fell swoop, everybody. Let's
nope,
just, make sure we're all clear on
yeah,
that. And Jim's been very clear that there's a long-term decline, from the 110 level that we're eventually going to, get somewhere
yeah.
down here sometime this year. So,
And
and
the
there's
basis,
a
because
lot
I
of there's a
haven't,
lot of months left in the year, Jim.
yeah, we got a lot of runway.
Yeah.
Where that target is coming from, Blake, is the dollar peaked in October of 22 above 114. I think it was like 114.78. It then dropped like 15.2 points before it made a low, just below 100. Then we had this really drawn out rally that got it up to the 110 level. I thought that was a B wave. So you had 5 down from 114 for A. You got this rebound to 110 for B. And what that implied was there was a C wave that would likely be 15 points. So that's where that target 95 came from, is just, hey, we had a decline of over 15 points. And if we get something similar in length, that's where 95 comes from.
All right, Jim. Well, the last chart you brought is obviously the one on TLT that you love to cover. Tell us what
Yeah.
we're seeing here.
Well, to me, this is tough because the economy is going to slow. And you and I have talked. I've repeatedly noted that if you're going to cut the deficit from true $2 trillion, which is what it was last year, to 1 trillion over the next 20 months, the economy is going to slow. That's more than 3% of GDP. Then you would throw on top of it, obviously, the uncertainty with tariffs. I mean, in the near term, consumers are pulling back. Wealthy people are pulling back a little bit. In terms of Delta Airlines talking about, whoa, all of a sudden we're seeing a drop off in sales. And, that's not the bottom 30% of wage earners. That's the top 20% of wage earners. And I've noted that, I think I had a chart 2 weeks ago showing the top 10% of wage earners are now comprise 50% of consumer spending. And that spending has been buttressed by big moves in asset values in terms of housing and stocks. And if you saw a decline in the stock market, those people would naturally pull back. So the table is set for a pullback, which would be constructive for Treasury yields to come down and for TLT to rally. I just think there's the potential in the near term that as these tariffs go into effect, they are going to be inflationary, Blake. It's just a question of, is it going to add 50 basis points to the CPI or something more? And so that's why I think TLT has room for a further decline. But right now it's in an uptrend from the recent low. And then I think ultimately, I still think Treasury yields are going to have a fairly meaningful decline sometime this year, as the economy does in fact show more signs of slowing.
Well, Jim, that does make sense, and so we might see a little bit of a pullback in TLT before that resumption of rally.
Yep.
Jim, I want to thank you for being here with us today. I know you're on holiday, and I want you to express to your wife and your friends that we appreciate them letting us steal you away for the last 15 minutes or so. And if you guys have appreciated it, make sure you give Jim a thumbs up. Jim, what's the best way for traders to get a hold of your work?
Macrotides.com. Send me an email to jimwelshmacro@gmail. I'll be happy to send the March Macro Tides. It's about a 20-page report, a lot of detail about a lot of stuff, and I've gotten some really nice, solid feedback on it. In terms of, again, my monthly stuff tries to put, the framework that we're in, try to create what that framework is, and then what's the implication for the financial market. So I'd be happy to send the March Macro Tides. Just shoot me an email, jimwelshmacro@gmail.
All right, Jim. Well, have a great trip home whenever you
Yep.
decide to make it home, and we'll look forward to catching up with you next week. And happy Patrick's Day to everybody. St. Patrick's Day
Thank
to
you.
everybody.
Yeah, you got to get that one right.
St. Patrick's
Thanks,
Day.
Blake.
Yeah.
Have a good weekend, buddy.
All right, you too. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.